Okay. So we have also, okay, understood in one way that like how the interest rate behaves, or therefore we have like discussed uh, about the behavior of interest rate, right? So the in like there we have discussed the supply of bond and the demand for bond, and therefore like we have computed the equilibrium interest rate and equilibrium price, and we have seen that like what is happening in the market. Okay, so the bond market equilibrium occurs when whenever the demand for bond is equal to supply of bond. Okay, and therefore in the intersection point of the demand for bond and the supply of bond, okay, associated with this price and the interest rate, we will get the equilibrium price and the equilibrium interest rate. So the bond market equilibrium occurs when P is such that the demand for bond is equal to the supply of bond. Okay, and if the price is such that the demand for bond is higher than the supply of bond, in case of excess demand, right, when the buyer will tend to bid up price, okay, to the equilibrium price, right. Okay, on the other hand, if the price is such that, okay, the demand for bond is less than the supply of bond, okay, or in the case of excess supply, then the seller will tend to bid down price to the equilibrium price. Okay, so let us also like recall we have the factors that determining the demand for bond. What are the factors determining the demand for bond? Remember, right, we have discussed several factors, right. One of the most important factor we have learned so far is price. Okay, and therefore we have also discussed like movement along the demand curve and shift in the demand curve, okay, or movement along the supply curve or shift in the supply curve. And we have understood that the shift will happen whenever there is a change in other factor, that means other than the price factor, price being the main factor. Okay, but here if other than that factor, okay, these factors we are actually recalling, we have now seen what is, okay, what are these factors. Remember wealth. Okay, how wealth is actually affecting the demand for bond. Whenever you have more wealth, you like to demand more bond, you like to invest more in bonds. Okay, so there is a positive relationship between the wealth of the bond or wealth of the people and demand for the bond, right. An increase in wealth raise the quantity dependent of any kind of assets. Okay, you want to have more investment, right. What about expected real return, real return rate? They also have positive relation. Okay, so as the like expected return increases, the demand for bond will increase. Okay, so an increase in an asset's expected return relative to that of an alternative assets will therefore increase the quantity demanded of that particular asset, right. There is a positive relationship between the expected return and the demand for bond. Okay, what about risk? Risk usually having the negative relationship with with the demand for bond, right. So what is risk? The degree of uncertainty associated with the investment, right. So the degree of uncertainty associated with the real return rate on bond is relative to alternative assets is basically risk, and there is an inverse relationship between the risk of the like bond or risk of the asset and the demand for the bond. Okay, okay, now that another factor that potentially influence the demand for bond is the liquidity. Okay, the high the the large or higher the liquidity of the bond, higher will be the demand for bond. So the more liquid an asset is relative to alternative assets, okay, the more desirable it is, and therefore people may demand more of such assets or such bond, right. So we have now understood what are the factors that determining the demand for bond. Any of the changes or the changes of any of such factors, keeping other factor constant, will actually shift the demand for bond curve. Okay, so a change in wealth will shift the demand for bond to the right. Change in expected real return rate will shift the demand curve to right. Okay, but change in risk will shift the demand curve to left. Okay, and then change in liquidity will shift the demand curve to right. Okay. So, what are the factors that determine supply then? Okay. So, other than price factor, okay, business expectation for the profitability of investment is also like positively associated with the bond or with the supply of bond. Whenever the business expects, okay, a future profit, okay, or expect that in the future his or the firm is going to get more profit, then probably he will issue more bonds, right. So there is a positive relationship between the business expectation of the firm, okay, and the supply of the bond. In such case, the supply curve should be or should shift to right. Okay, expected inflation. Okay, whenever inflation increase or whenever people expect more inflation, then also, okay, they will like to borrow more, right. Borrowing cost will become less, okay, and therefore the supplier would supply or the issue more bond. Okay, so there is a positive relationship between expected inflation and the supply of bond. What about government budget deficit? Remember that we have understood government bond, right. Government also issue bond whenever it requires money, right. So whenever government find that there is a deficit in its budget, then, okay, to support the fund, okay, it may issue more bond, right. So there is a positive relationship between government budget deficit and the supply of bond. Okay, what about corporate tax? If government induce corporate tax, then like you may think that it may have a negative relationship, but remember government also has now introduced what is known as a tax shield. Okay, so tax reduce the profitability of investment, and that may be the reason you expect a negative relationship between corporate tax and the supply of bond. However, sometimes and like most of the time, firm issue or firm will choose a debt financing route to take the advantage of this tax shield. Okay, or like we know that the corporate bonds are tax deductible. Okay, right, or interest and or interest payment on the corporate bonds are tax deductible. Okay, and if this is the reason, if the firm want to take advantage in, and therefore it induced to supply more bond, then there may be a positive relationship between corporate tax and the issue of the bond, right. So we have now listed some of the factors that determine the demand for bond and that determine the supply of bond. Okay, changes in these factors may influence the bond by shifting the like respective curve. Okay, or demand and supply curve, right. We have also like understood the Fisher effects, right? Nominal interest and real interest rate, which is induced by the Fisher effect. Fisher effect is what? The expected inflation and the interest rate will tend to move together over time. So Fisher in effect, like tells us that there is a positive relationship between the expected inflation and the nominal interest rate. Whenever people will expect a higher inflation, then interest rate will tend to increase, right? Or put it differently, that the nominal interest rate can be computed as the real interest rate, okay, plus the expected inflation, and therefore the real interest rate can be like computed as nominal interest rate adjusted for expected inflation, or simply nominal interest rate minus expected inflation, which is very popular in economics and in finance as well. Okay, so an increase in the expected inflation rate lowers the expected real interest rate, okay, as we have already seen, right? So an increase in the expected inflation rate lowers the expected real interest rate. Okay, now again come back, okay, to demand and supply of bond, and in which case, okay, when expected inflation rise, the supply curve shifts to right, okay, and the demand curve shifts to left, right? So whenever there is an expected inflation, okay, an increase in expected inflation will make the demand for bond curve, okay, to shift to left, but the supply curve will shift to right, okay. This causes the equilibrium bond price to fall, and therefore the equilibrium interest rate to rise, okay. Secondly, okay, in the second, okay, in a business cycle expansion, right, remember that we are actually putting this supply curve and demand curve together, okay, and we are actually trying to understand what will happen to the demand for bond and the supply of bond, okay, if there is a change in the expected inflation. And now we are we are trying to recall what we have learned at the business cycle expansion. When like in a business cycle expansion, when income and wealth are rising, okay, both supply and demand curve will shift rightward. Both the curve will shift rightward in case of business cycle expansion. So if supply shifts more than demand, then bond price P should decrease, and therefore the equilibrium interest rate will increase. If demand shifts more than the supply, then bond price P increase, and therefore the equilibrium interest rate decrease. Okay, in either case, okay, the quantity of bonds sold will increase, right? That's what we have like learned it using the diagram. Now I am not using the diagram, we are simply concluding it, okay, by recalling whatever we have learned, right? Again, one important concept I have taught you, that why do interest rate fall during the recession, or why you are why you have seen that like interest rate is usually less during the recession period, okay. So note that in the recession situation, okay, households will experience a declining wealth, and firm will become more pessimistic about the future profitability of investing in the physical capital. Okay, so their motivation therefore will decline, right? So the declining household wealth cause the demand curve for bond to shift to the left, okay, and firms declining expectation of profitability of investment in the physical capital cause them to issue fewer bonds, okay, which shifts the supply curve for bond to the left, right. So the equilibrium bond price therefore will increase, okay, as long as the supply curve for bond shifts more than the demand for bond, right, and therefore the equilibrium interest rate will fall, right. This also we have understood using a diagram, right. So, like, and from policy perspective also, whenever, okay, there is a recessionary situation, then the policymaker will actually try to curb such recession, okay, by reducing the interest rate, okay, in order to or aiming to give one kind of economic stimulus to the company. Remember that there is an inverse relationship between interest rate and investment, okay. So one of the explanation is that if you decrease the interest rate, then there is a chance that investment can boost, okay, and therefore it can help the economy to again grow, right, okay. So output may increase, that also one reason, okay. You can see that during the recessionary situation, okay, interest rate is declining, okay. So we have also understood the risk structure of interest rate and therefore the bond ratings of the and bond ratings, okay. So what are the risk structure and what are the risk? Several risks, okay. Bond involves risk. Most important risks are the default risk and the interest rate risk and also inflation risk, right. So bonds that have the same maturity may have different with respect to the other characteristics that investors believe are important. For example, okay, liquidity, okay, risk, information cost and also taxation purpose, right. Even if the bonds or have the same maturity dates, okay, the risk structure or the structure of them actually are different. This is the reason, okay, the price and interest rate of such bonds are also different, right. So the relationship among the interest rate on bonds that have different characteristics but the same maturity is known as the risk structure of interest rate. Remember, we have already understood the risk structure of interest rate. The relationship among the interest rate on bond that have the different characteristics but same maturity, right. For our curiosity, if like they have the same risk characteristics, risk structure, but different term to maturity, then that like that is known as the term structure of interest rate, that we will discuss later, okay. We have already understood that also. So bonds having no default risk are known as the default free risk. Most of the government bonds are default free, okay. So the spread between interest rates on bonds with default risk and interest rates on default free bonds, both of the same maturity, is known as the risk premium, okay. So again we have understood that a bond with default risk will always have a positive risk premium and an increase in its default risk will raise the risk premium. Why it is so? We have again understood this using the corporate bond and the government bond by like considering some diagrams, if you remember, okay. I'm just summarizing that figure, okay. So an increase in default risk shifts the demand curve for corporate bonds to the left and shifts the demand curve for treasury bonds to the right, okay. So if you are comparing between the corporate bond and the government bond, here the treasury bond is actually the government bond, okay, then like an increase in default risk, okay, because corporates are like corporates are expected to like associated with what is known as the default risk, okay. An increase in default risk will therefore shift the demand for demand curve for corporate bonds to left and it will shift the demand for demand curve for the treasury bond or the government bond to right, okay. What does this means? People will demand more treasury bond than the corporate bond, right. So therefore it lowers the corporate bond price and it increase the government bond price. When people will demand more government bond, then price will increase, okay, for the government bond, right? And therefore the equilibrium interest rate, okay, is high for the corporate bond and low for the government bond. Remember that the price of government bond is high and therefore the interest rate, okay, if for the government bond is less, right? Okay. Now what is bond rating? How do you know that a firm is actually worth investing in its bond or not? That means what is the credit worthiness of the firm? And investors, while like investing, okay, it want to analyze that whether the firm is worth considering for investment in bond or not, right? Like it mostly depends upon whether the firm is credit worthy or not. Okay, so how do you know that? The rating agency can help us in like rating the firm, okay, or the bond on the basis of certain characteristics, right, or the creditworthiness, right? So a bond rating is a single statistics that summarize a rating agency's view of the issuer's like ability or likely ability to make the required payment on its bond. That is mostly the creditworthiness of the bond. Okay, highly rated firms are highly creditworthy. That means like the chance of bankruptcy is very less for them. Okay, so there are some rating agencies who can help us in this regards are Moody's, okay, S&P's, right, Fitch and CRISIL in India, ICRA, CIBIL. Okay, remember, like whenever you go to the bank, then bank will ask what is your CIBIL score. Okay, then this is actually, okay. So the CIBIL also will give you the rating of the bond, right? So bonds with a relatively low risk of default are called as investment grade. So there is an like there are bonds that are known as investment grade and non-investment grade. Okay, so bonds with a relatively low risk of default are called investment grade securities and have a rating, okay, most of the time higher than BAA or BBB. Okay, so any rate, okay, above this BAA or BBB are considered to be investment grade, okay, bond or investment grade security, right? Other are known as the junk bond. Okay, so bonds with relatively less rating, for example, they are lower than BAA or BBB, okay, have higher default risk, okay, and have been aptly dubbed speculative grade or junk bond. Okay, they are known as junk bond, right? So they are also called non-investment grade. Okay, or you can simply call they are high yield bond. Okay, they are high yield bond because the chance of the default is high. They must offer a high interest rate to attract the investors. Okay, so because these bonds always have higher interest rate than investment grade securities, they are also referred to as high yield bond. So junk bonds are high yield bond category. Okay, so I think we have reviewed almost all. Okay, right, starting from week 8, week 9. Okay, and in week 10 we have discussed term structure of interest rate, and week 11 we have discussed the duration and the Macaulay duration and modified duration and convexity. Okay, we will review this in the next session, right? So we will stop here today, okay, and we will meet in the next session to review the term structure of interest rate and the Macaulay duration and modified duration and convexity. Okay.